If there was ever a market where you should practice tried and true investing strategies like dollar cost averaging or time in investing, it's 2024. I mean, the headlines and the reporting, it's all over the place. One day we have record unemployment. The next week we have slow job growth. One week we have record job growth, and then we have rising unemployment. We can't tell if we are in slower inflation or we're in growing inflation. And because the economics are so confusing, if that was a reason that you were waiting on the sidelines, it looks like it's going to be another roller coaster for at least as long as I can tell. And so because of that, I want to break down what's actually happening in this market cycle that might make some sense for you, at least in the short run, and why it's so important to just invest for the long haul and what a good buy box looks like if you decide you want to invest in real estate. Now, for those of you who are new to the channel, my name is Lizy Hoeffer. I'm a residential loan officer at Cross Country Mortgage, and I work in Phoenix, Arizona. And I like to teach people about practical money tips so that they can make a smart home purchase or an investment. If you're new to the channel, welcome. And if you find the information valuable, don't forget to like, comment, and subscribe, and maybe share it with a friend or family member. So I think it's important to explain why investors use these headlines and they use these economic reports when it comes to investing. And that's because a lot of them manage a lot of large retirement funds, a lot of hedge funds, investment funds. And what they're looking at doing is maximizing their yields, so their rate of return on investments. And a lot of that has to do with how a stock will perform. And so when they raise the Fed funds rate, the idea is that they're making it more expensive for banks to loan out money, which will then lower the profits of these businesses. Lower profits might mean to layoffs, and you can see the dominoes that might impact a stock's valuation. And so because of that, these investment managers, they're looking at these economic reports and then they're acting accordingly. So when there's a lot of volatility in the stock market, generally what happens is that a lot of them will sell a position and then move it over to mortgage-backed securities or move it over to treasury bonds. And those investments, they pay a lot lower of a yield, but they are consistent and safer, and they hedge against inflation. And so that is why a lot of people look at these economic reports to gauge their financial decisions. Now, me, obviously, as a loan officer, I'm reviewing them to give best advice on when to lock a loan, but that's the reason that I pay attention to them. And I think that a lot of consumers get misled with all of these headlines, and they're very fear-mongering just because of what we experienced as children. A lot of us were children or teenagers during the Great Recession when our parents maybe lost a house, filed for bankruptcy, did a short sale. And so we have a lot of financial trauma. When I've talked to consumers about their reasoning behind not wanting to get into real estate or make an investment, their fear is that they're going to lose it all, or that they're going to end up in a position where they can't pay their mortgage. Now, there are a ton of videos on market crashes, a lot of data on why there isn't going to be a crash, but I will tell you that the biggest difference between this market and last market just has to do with the way that mortgages are qualified and the fact that people are sitting on a ton of equity and mortgage positions, meaning monthly payments, that are lower than they can find in rent right now because interest rates were so low for such a long time. So I am not really worried about that. But when you make a decision based on headlines, what's hard is to know when exactly to jump in. And when you're timing the market, it doesn't matter what type of investment, and you're looking at not keeping it for the long haul, most of the time you can look at that yield curve, you'll notice that it's not the best return on investment for anything. And so my recommendation, especially in a market like 2024, is to really review what your budget says about your ability to repay. I would say the number one question I get asked by consumers when they're trying to qualify for a house is, how much can I afford? And that question is really tricky because what you can afford and what you can qualify for are probably two different things. So what we do in mortgage qualifying is we base the new monthly payment with all of your current debts, and we calculate it against your income. And that's called a debt to income ratio. And that's actually what we use to say, here's the maximum qualification. Now, oftentimes, and this is just anecdotal experience, people will feel like the payment that they can max qualify for is higher than they feel comfortable paying in their monthly budget. That's for a number of reasons. One, people aren't used to paying higher than their rent. Two, they just feel uncomfortable. They know they have other expenses that maybe aren't reporting on credit that they have to account for, or they just want to make sure that they have enough money to live a lifestyle that they feel comfortable with. And so in order for you to determine what makes the most sense for you, you want to really look at 3 months worth of savings, spending, and what your debts are, and really calculate like how much of your income is left over at the end of the month for things like adding to your retirement account, adding to a savings account, paying down principal reduction payments on debt, or are you living paycheck to paycheck? So I will tell you that the figure that most of my clients feel comfortable paying when they don't have a ton of consumer debt is around 29% of their net take home income for a mortgage payment. That will range based on, how many people are actually going on the home loan or not, or if there's income that maybe isn't reported on a tax return or on a paycheck stub. I mean, a lot of people collect for tips, or maybe they're doing like a side hustle that maybe isn't being accounted for in a paycheck. So just know that number will vary, but typically it's like a third of what their net take home income is. Now, a budget, if it's done right, will allow for at least 10% of your net take home income to go towards a rainy day fund, so your savings or your retirement, and then you will have money left over for things like a principal reduction. I always like to say, hey, if you can allot for 20% of your net take home income to go towards paying down debt, like credit cards and auto loans or any kind of installment loans, over the long haul, that will compound and you'll have greater cash flow for things like buying, additional investments or upgrading your home. So it's very understandable, given people's financial histories, the headlines that are all over the place economically, why someone might want to wait for a more stable time or a more budget-friendly period of time to purchase. But for those people who could safely afford, who can save, who can pay down debt, who can live their lifestyles and still afford a payment at 7.5%, I want you to pay attention to this. To give you some context, interest rates started to peak at 7.5% somewhere around August, September of 2022. And then they peaked again in August, September of 2023, and they got into the 8s. And people who bought then still had homes that appreciated and still made at least, guys, it's looking like over 100% return on their cash investments. And that's pretty huge. And so I want to showcase that for you right now, just so that you can see what it costs you to wait on the sidelines in terms of home appreciation. I've done 2 scenarios, and for the scenarios, guys, I did not include property taxes, mortgage insurance, and I did not include homeowners insurance because those are all things that vary person to person, state to state, property to property, okay? So this is just a comparison between a 30-year amortization with a 5% down payment. So in scenario 1, I did a $400,000 purchase price, like I said, with a 5% down payment, 30-year amortization with a 7.5% rate. Now, for this scenario, I am assuming a 5% appreciation because that's pretty standard for a stable market. And we know many marketplaces are well over that, especially here in Maricopa County. We just got reported at 12.2% with Redfin. Now, the second scenario is somebody who buys 3 years later. That would be a 2025 time point. Let's say this person bought in 2022, because that's when most economists are thinking that interest rates will be in the mid-5s. Now, the purchase price, because the home, that same $400,000 house, has appreciated 5% annually, is now $463,050. Now, again, the second scenario involves a 5% down payment, a 30-year amortization, except this time it's at 5.5%. So it probably wouldn't surprise you that buyer 2, even buying at a substantially higher purchase price with a 5.5% down payment, still has a lower monthly payment. And for a lot of people, this difference in cash flow is reason enough to wait on the sidelines. But I want to caveat that with the monthly difference is about $163. And not that that's anything to balk at, but over a 3-year time period, that's $6,000 in savings versus a $63,000 return on a $20,000 investment. I think the comparison is pretty much a landslide in buyer 1 scenario, but it's a really hard thing to articulate to consumers who are overwhelmed with fear and indecision because the market conditions seem so unstable. And so people who are buying and holding for the long haul will see appreciation, even if appreciation starts to dip. Let's say it goes down to 3%, in 1 year it's 10%. Over the long haul, this type of thing compounds. And people who bought in 2022, at least in Phoenix, Arizona, my first year of appreciation was over 7%. My last year's appreciation was 12%. This year, I'm assuming it's going to be another double-digit appreciation year. And so for me, I'm really happy, even though I did actually buy in August of 2022, because I know that real estate is for a long haul. People who bought in 2021 saw a slight dip in their purchase, but had they kept their property until 2025, they would still have returns on their money. There's an old adage in real estate that the best time to have bought was 5 years ago, and it's because of this law of appreciation that you want to consider. But it's really hard to articulate this point when market conditions seem so volatile and interest rates seem so high. I don't want to minimize people's fears about their monthly budget, because that is probably the most important factor to consider when you're buying a property. But again, if you're somebody who is just waiting on the sidelines and has a budget that is ready, you are foregoing pretty significant returns on your money. So I want to wrap this video up with talking about a little bit of economics. And I know I said that even the best economists are having a hard time predicting where the market is going, but there's a little bit of economic news that I think will play out positively for mortgage-backed securities, and that has to do with quantitative tightening. And I recorded a video that explains that in more detail that I'll link below. But essentially, the federal government has had to liquidate their assets of treasury bonds and mortgage-backed securities, and because of that, we've created liquidity issue in the banking system. And so they're having to taper their efforts quite a bit. And that will mean that they are going to purchase treasury bonds and potentially mortgage-backed securities. And when they do that, rates should drop. And if rates drop, I just want to remind you that we have 3 to 8 million people that are waiting on the sidelines to purchase. And if they do that, we have a limited supply of houses. And so if you know the law of supply and demand, we will see home prices raise at, I think, a pretty rapid rate. And so not only will you be battling appreciation increases in purchase price, you will be battling just the marketplace conditions for why home values will rise. And so I want you to consider that. And I don't want to I don't want to be one of those people that's fear mongering. It's just something to consider as interest rates go down, market conditions change. And one of the leverage points that you've had is these high interest rates to negotiate things like closing costs and repairs. And those things are harder to come by in a more competitive scenario. Let me know what questions you guys have in the comments below. You know, I'm always happy to answer them for you, but just keep these things in mind as you're making any kind of investment, especially with real estate. Thanks for tuning in, guys.